What is next for tech? You still have 10-year yields right around that 3% level. Want to ask Cameron Dawson, Newedge Wealth Chief Investment Officer. Cameron, great to get your perspective. It's a broad question, but one as we're in an inflection point, really, when the economic data is still kind of confusing. What is next for tech?
Well, I think if we look at the tech index overall, it still is rather expensive. It's still trading at a 20% premium to the S&P. And so this would argue that there's still room for that premium to fall. Prior to 2019, tech actually traded at a slight discount to the market. And if we look at earnings estimates for tech for the overall sector, they've actually held in really well despite all of the uncertainty in a really rough earnings season. They're still running at 13%. They haven't really been cut. Now, that's not to say that there's not opportunity within tech. We just have to be very, very selective and very disciplined about valuations. There's lots of quality names within tech that have strong free cash flows, really good ability to be able to return capital to shareholders, but you can't pay any price for that. And the valuations we got to at the end of last year were so extended. And so there's a few areas where we've seen valuations compressed enough to get us interested, but overall the sector still looks both optimistic and rather expensive.
Okay, so we, in your view, need to get some sort of a re-rating still on the downside. At what point does tech start to look attractive, though, Cameron? If we go into a recession, a deep recession, but a relatively short recession, how do you want to play tech across that chasm?
Tech is quality in a lot of areas. It has superior growth. It has better balance sheets. And it really comes down to, again, being disciplined about valuation. Because if we look at the last cycle, look at 2020 when we saw a big, sharp correction in earnings growth, tech actually grew earnings through that period where the rest of the market saw big cuts to earnings growth. Now, growing earnings over those 2 years in 2020 and 2021 likely pulled forward some of that earnings growth. So it's unlikely that we would see the same dynamics that really caused tech to have that super normal growth. But it is a very good point that it has been a good place to hide in prior downturns because of its earnings resiliency and ability to outgrow the market.
Cameron, what happens if the Fed can actually do a soft landing? I feel like after the jobs number headed into potentially inflation that won't go any higher, that is becoming a more distinct possibility. If that happens, does it change how you feel about tech?
Not necessarily, because if we are going into a soft landing where we're not having the most dire of economic outcomes, it could be that we see more cyclical parts of the market start to recover first. So areas in consumer discretionary that have been the most hard hit. If you look at those earning estimates, they've gone from 45% growth to start this year down to just 25% today. So if we are going into a scenario where growth can start to rebound from here, and I think that remains a big if, tech certainly should be part of portfolios. It's a dominant weight, likely can deserve overweights if we resolved the valuation premium part of that question, but then we'd look to layer in some more cyclicality, a little bit more beta if we're going into a better economic environment.
Talking of the soft landing, how late cycle are we? How far away is a recession?
I think we are very late cycle. I think it's too late or too early to say a recession is imminent. If we look at the technical definition of a recession, 2 quarters of negative GDP growth, we do not look to be as if we are fulfilling that technical definition at this time. Yes, GDP was negative last quarter, but if we look at the data year or quarter to date, Atlanta Fed still has us about 1%. You look at the labor market, that still looks to be very tight, easing some, but coming off of record tight levels. PMIs, services, and manufacturing, still in expansion. So we're not in a recession yet.
Okay, but is a soft-ish landing a soft-ish recession? People talk about these things, and I don't really ever see them nailed down properly. We can get a recession, but can it be a soft-ish recession? And how different is investing in a soft-ish recession versus a full-on recession?
Well, I think it comes down to duration and magnitude. A full-on recession that comes with a debt crisis has deeper drawdowns that are more protracted. That's when it really makes sense to dial back equity positioning, going into more defensive positioning in fixed income. If it's just a growth recession that doesn't have a debt crisis associated with it, it's more inflation, it's likely that there's less downside and that it lasts a lot less long. And so this is something that I think that we'll have to watch yields to give us an indicator of how deep we might go. If yields continue to march higher, that would be an indication that we probably aren't going into a recession, because the bond market will sniff out growth fears and distinct growth fears a lot earlier than equities will.
Okay, so just wrapping it up on that point, Bloomberg had a note out that said that hedge funds net short on Treasuries at the end of May. They're the most net short since June of 2021. Would you agree with that assessment, or at some point do you need to also add some diversification here?
Well, I think we can also see in CFTC positioning that Treasury positioning has become rather short. It's not as short as it was in 2018 when we saw yields peak. So that could argue that there's still some upward pressure on yields, even though we have moved short. And if you look at the trends within yields as well, yes, we've pulled back a little bit over the last couple of weeks, but we remain in very distinct uptrends. Yields in the 10-year have corrected right down to their 50-day moving average, bounced right back off of it. So that would indicate that even though there's been a narrative that we've seen peak yields, that it's not really being reflected in market pricing yet.